And so when you think through the sound money, it sounds like you and I agree that that sound money is going to be crucial for the future. It is that constant you talked about in financial markets where there haven't been constants in the past. But you've also written about this idea of a Bitcoin black hole effect. And this to me is like one of the most fascinating concepts in the entire market and one that is heavily misunderstood. So talk through what exactly is the black hole effect and then how does that apply to Bitcoin?
Yeah, sure. So it's a couple different things that I kind of put together in that piece. The first one was just obviously what we just talked about, the global macro backdrop of money printing and infinite QE, and now we're seeing UBI. And the other two things are what we had mentioned about the over collateralization, which is kind of accelerating the rate of coins being pulled off exchanges. And the third thing I touched on in that piece was the speculative attack, which was made popular by Pierre Richard. And that idea is basically that you're leveraging a bad currency against one against a hard sound currency, and that's something we've seen Michael Saylor with MicroStrategy do, where they've issued convertible debt notes most recently at 0%, which is insane, $900 million, which was all. It should be mentioned that it was oversubscribed too at 0%. And so what Michael Saylor is essentially doing is he's leveraging the failing currency against an emerging hard sound money, which is Bitcoin.
And so when you do that, I think that the most fascinating part to me is basically people are giving you free money and you're taking it and you're converting it, right? Like when you're talking about leveraging it, you're literally taking a bad currency that is being devalued and you're buying a hard currency, which is purchasing power has continued to increase.
Yeah, exactly. And, I was talking to Preston the other day and he was telling me, I think Michael Saylor could have actually issued it at a negative yield because at the rate that the Fed is driving down interest rates, and in Europe you're seeing negative interest rates, and here we're seeing negative interest rates in real terms. And essentially what people are doing that are buying into these convertible debt notes is they might not be able to get exposure to Bitcoin through other ways, through buying market price or buying different shares like a Grayscale Bitcoin Trust or something like that. So they're trying to look for an alternative way to get exposure to it. But in addition, with the interest rates going down, by buying these notes at 0%, they essentially will benefit if rates go negative. That's kind of what you're seeing in Europe, is that people are buying negative yielding bonds because they're betting that the yields are going to go further negative. And so that could become really dangerous once that kind of unwinds. And so I think, in my opinion, that's why the Fed is going to have to continue to buy in through the fixed income market and keep driving these yields down, because the second that they start to reverse, everything is going to unravel.
So when you think about the black hole effect itself, right? Explain that.
Yeah, so it's just the idea that Bitcoin kind of sucks everything in, and every 4 years the supply cuts in half, and when you have these cycles, we have these kind of blow off tops, and then through the bottom, every single bottom that we've seen is is higher than the previous one. And so what you're seeing is this growing network effect, similar to anything like Facebook or anything like that, but we've never seen that with a monetary number attached to it. So I think that's why people are really taken back by Bitcoin's price movement. But these 4 year halving cycles will continue and they'll persist until the year 2140. And so essentially, if you can think of it like a battering ram, and it's continuing to bang against the legacy financial system until at some point it's going to break through. And so there's that aspect of it. And then in addition, right now, like I had mentioned, the futures are trading to a premium to the current spot price. And so if the market starts to identify the yields that you can get essentially risk-free through that process of arbitraging those spreads, and if the market starts to recognize those yields as the real risk-free yield, you're going to see a complete repricing of assets. Particularly stocks, they're all priced based off of risk-free yields. When you do a discount cash flow model, you use treasury yields as your discount rate. And right now that discount rate, for the 10 years, I think it's hovering around like 1.5%. And if the market starts to identify these Bitcoin yields, which are blowing out to 10, 15% plus potentially, then you're going to see a stock market, for example, just as a round number, if they blow out to 20%, you're going to need to see PE ratios go well under 5. And right now, the average PE ratio of the S&P is over 34. So you're looking at a 75 to 80% correction in the stock market if that were to hold true. And not only that, but a PE ratio of 5 would just match this risk-free rate, right? I'm not gonna invest in something that is risk on, that's offering the same yield as something that has no risk. It would have to be substantially lower than that. Um, and the yield that it's offering would have to be substantially higher than that risk-free yield. So you may actually see PE ratios go even lower than 5 to maybe 2, 3 if we start to see these yields blow out to 20+%.